I want to take this time to dive a little deeper into the mortgage pre-approval process and give you some background as to how banks will analyze your financials to determine whether or not you're suitable to get a mortgage. Um, Most banks lend based on what are called the 4 C's of lending. And the 4 C's stand for capital, capacity, character, and collateral. Capital simply refers to your assets. How much money do you have in the bank? And this means, will you be making a large down payment, a small down payment, and after your down payment, how much money do you have left over? All of those factors determine what type of loan you can get and whether you can get one at all. There are low down payment programs on FHA and with other banks that allow you to put as little as 3.5% down, even 3% down, and that 3% can be a gift. So there are loans out there that require very little capital. However, the less capital that you use, the riskier it is for the bank, and you'll find that those loans are more expensive than if you had more capital. The second C is capacity, and capacity simply refers to your income and your ability to actually repay the debt. And banks look to see how long you've been earning your current income, how stable your job is, and how much the housing payment is going to affect your total debt load. And they're really concerned that you're able to afford the house and that there's some room there and some give if there were some changes in your financial situation. The third C is character, and that refers to credit. And in the banking world, the best predictor to future performance is your track record, is what's happened in the past, and that's where credit scoring and credit history come into play. So all banks run a tri-merge credit report. They analyze your 3 credit scores. They're going to take the middle of your 3 scores, and they're going to look at your how you've repaid your debts, your revolving debts, your installment debts, if you've had any cars, houses, etc. And depending on that track record, that will determine the type of loan you're able to qualify for as well. The fourth C really isn't something you can control. It's actually the collateral of the home, and it refers to the appraisal. And when banks lend money, they're lending money basically on 2 things. They're lending money to the individual, you, and they're also lending money against the house, which is what they get if you don't pay them back. So it's very important to the bank that the appraisal is sound and that the value is 100% accurate, so that if in the event you're not able to pay them back and they have to take the house back via foreclosure, that they'll be able to minimize their losses on the money that they've extended out to you.